Joining us right now is John Boivin. He is the head of the BlackRock Investment Institute, and he's got a very interesting paper on what's been happening with central banks and what happens next. John, thanks for being here. It's good to see you.
Great for having me. Thank you.
First of all, your thoughts on what Peter was talking about, just the German 30-year now yielding a negative 20 basis points today. Can you believe this situation? $16 trillion almost in negative rates for sovereign debt around the world?
And more than 60% in Europe of the bond universe yielding negative. I think it is mind-boggling. I think there are massive forces behind that are related to big risk aversion and flight to safety, and I think this is what we're seeing playing out. But it's raising big questions about what's going to come next, especially from our side. The biggest question is not so much whether we have a recession now or not. I don't think we have one. I think trade is a big driver of what's happening in terms of markets, the biggest driver. The biggest question for us is what's going to happen when we have the big shock next, and central banks are not clearly able to do much, in our view.
I want to dig into the bigger question, but I think it's very important what you just said. You don't think that this is signaling a recession, the inverted yield curve?
No, I think the if you look at the fundamentals overall, we think it's slowing down. The slowdown is material globally. Europe, Germany is doing bad. This is a big beta to global markets, global economy. So it's slowing down, but there's no clear dynamics that should lead to a recession per se, except if there is big tensions, big shocks. So that's why geopolitics, trade, is the biggest driver. But without these shocks, I think there's no big imbalances that would trigger necessarily on its own a recession.
Your bigger concern is that we are now in a situation where, with monetary policy, where you can't do much more, and with fiscal policy going to be under some extreme pressure too because of politics. Yeah.
So the reason why it's the biggest concern to us is that if we don't know when the recession is going to happen, and over the next couple of years, it's very likely we're going to see something that's going to look like a recession. And we don't quite know what's going to be available in terms of responding to this situation. And I think that's what creates nervousness on the part of investor, and that's a part of the reason why there's such a big bid for long duration assets. That's the protection you're seeking if you don't know what kind of policy
would be. So is the Fed behind the curve?
No, I think the point here is that 25 basis points here and there is not really the solution to this confidence problem. It's more, what's going to happen? What can they really do when there's a big shock coming? And with the yield curve as flat as it is now across all maturities, there's not room to do much. There's not room to do anything sizable to respond to a typical garden variety recession as we've seen in the past.
Well, we're not going to have one anyway, so we don't have to worry about that. Right?
I'm not worried about this being the reason why we should be at this stage. In 2019, this is not the driver shouldn't be a driver of concern. But as shocks are accumulating, market is focusing more and more about what can we do about this.
I mean, could you do QE again?
Oh, sorry.
You could do it again. Right.
Well, all of these policies, I think they work. They have worked by lowering rates. First they started by lowering the short-term rates, the policy rates. Then when that was not enough, then we start to work up the yield curve and buy long-duration asset and, flatten the yield curve.
It works in doing that, but it doesn't work in stimulating economic behavior. And if you're in Europe, I argue that the ECB is actually restrictive because it's killing their banks. So how do you expect faster growth when you destroy your banks and their profitability?
Can I just, before he answers that, I just want to say Peter is an advocate of something that has a little bit of support out there in the world. Little bit, but from some smart people, among them Peter, about the Fed targeting the yield curve, right? You think that what the Fed ought to do is take action to establish a positive relationship between the 2 and the 10 so that banks can lend profitably.
Well, I am for, if the Fed wants to cut rates, I'm against them repeating the mistakes of the BOJ and the ECB and just going back to zero. I think that they're going to cut rates. They have to stop at like 1% and say, you know what, that's all we can do. Because we don't want to damage our banks. We don't want to be in that rat hole that the ECB and BOJ are now stuck in and trapped at these lower levels.
John has his own solution, and it's one that I really had to read through a couple of times in your paper and get my head around it, because we've all been taught for years and years and years and decades that monetary policy and fiscal policy have to be run separately by separate institutions. The Fed and the Treasury should never kind of commingle. You've got this idea, like a Ghostbusters idea, which is, okay, cross the streams and actually team the two of them up.
Yeah, so I think the issue starting to where we left it and then getting to the way we're seeing things is I don't think the yield curve lowering rates is effective anymore for various reasons. We can talk about the impact on the banking sector and the pressure it's putting, but even independently of that, there's not much room for rates to go lower. So as a result, we think inevitably the next crisis will require policymakers to blur the distinction between fiscal and monetary policy. All the measures you can think of will have to have a flavor of going direct. What we call going direct means bypassing the interest rate channel, trying to stimulate the economy without having to lower rates. Anything you think that has this kind of flavor has a fiscal element to that. We've seen some of that in the last crisis. Some of the credit easing we've seen were like blurring already the distinction between fiscal and monetary policy.
Was a blurring of that, and
so is MMT, right?
MMT is that's typically what happens in a crisis, and it's not a long stretch from what you're saying to helicopters.
So, and
right?
the extreme,
helicopters dropping money down on people.
On the sky,
the extreme form is helicopter money, absolutely. But once you go down that path, it's an extremely slippery slope, which we're very worried about. You're blurring distinctions. Central bank independence is not part of the picture anymore. And how do you control, reckless fiscal spending in a world like this? So. The point here is we think that the pressure, if we will push in that direction no matter what, because we're going to see the toolkit being completely bare. So the point of what we're talking about is how do we put guardrails around that? So it is the case that we need to think about ways of bypassing interest rate. It will have to have some fiscal element in nature. How do you do that in a way that maintains institution credibility and strength at the same time as providing that stimulus? And to do that, we think that there needs to be, what we talk about is exploring the possibility of an emergency standing fiscal facility that could be available only, when monetary policy is tapped out, and how it could be putting the guardrails in order to.
Larry's been saying we need to pass the baton from monetary to fiscal for a long time. He's on at 8:30, so we'll talk to him.
So is Draghi, by the way. That's all Draghi ever says.
I don't think we've ever used QE to buy S&Ps yet. Why can't we use QE to buy S&Ps? Have we tried that yet? Can't you use?
Japan has.
And really get this market cooking.
I hope people on the radio see the smile on Joe's face, because that was a devilish smile.
Should.
People have tried it though, right?
Bad idea.
They have.
Bad idea.
In Japan.
Miserably at it.
In Japan, it hasn't.
They own
really.
70% of the ETF
We get
market.
this S&P up to 4,000 quick.
Don't give anybody any ideas.